In the vast, pulsating heart of China's real estate boom, a titan rose, Evergrande. It was a colossus of ambition and scale, a company whose name became synonymous with rapid growth and boundless aspiration. For years, Evergrande seemed invincible, its sprawling developments reshaping skylines and fueling dreams of prosperity. But beneath the glittering towers and glossy brochures lurked a precarious foundation, one forged not of solid ground, but of towering debt and fragile confidence. The story of Evergrande's liquidation in 2024 is not just a tale of financial collapse. It is a cautionary epic about the perils of overreach and the silent unraveling that no empire sees until it's too late. Evergrande mattered because it was more than a developer. It was a symbol of China's modern economic miracle. Its projects touched millions, its debts intertwined with banks, investors, and suppliers across the nation. Yet the first whispers of trouble came quietly. Subtle delays in payments, shifting market sentiment, a growing unease among creditors. In those early signs was the psychological imprint of overconfidence, a belief that expansion could outpace risk indefinitely. Executives and stakeholders alike seemed caught in a collective denial, blinded by previous successes and the relentless pressure to maintain growth. Groupthink took hold. Questioning assumptions was discouraged, optimism was mandatory. The roots of Evergrande's fall lay deep in critical decisions marked by hubris and miscalculation. The company had embarked on an aggressive expansion spree, acquiring land and launching projects at breakneck speed to capitalize on soaring demand. This relentless growth was fueled by an unsustainable mountain of debt. Loans stacked upon loans, bonds sold to an ever-widening pool of investors hungry for returns. Compounding this was management's failure to adapt to tightening regulatory constraints imposed by Chinese authorities aiming to cool the overheated property sector. Evergrande found itself trapped between diminishing cash flow and mounting obligations, a financial squeeze that tightened with every passing quarter. The narrative tension sharpened as three turning points crystallized the inevitability of collapse. First was the reckless expansion strategy that stretched capital thin and exposed vulnerabilities in cash management. And second came regulatory crackdowns that restricted borrowing and heightened scrutiny on corporate leverage, stripping away Evergrande's ability to refinance or raise new funds. Finally, the erosion of investor confidence triggered a cascade effect. Bondholders balked at risk, buyers delayed payments, suppliers demanded upfront settlements, each reaction accelerating the company's spiral. Behind these events were human elements charged with emotion. Executives driven by ego refused to admit failure. Employees faced uncertainty. Families waited anxiously as homes' promise remained incomplete. Evergrande's liquidation in 2024 stands as an indictment not only of strategic errors, but also of a broader cultural dynamic. A relentless chase for growth without adequate regard for sustainability or transparency. The moral lesson echoes across markets. No matter how towering a company's presence appears, ignoring fundamental financial discipline and external realities invites disaster. Could Evergrande have chosen restraint? Could it have restructured earlier or embraced transparency sooner? These questions linger as we reflect on what might have been avoided. Now, as we watch the remnants of Evergrande's empire unravel, we are left to ponder one final question. At what precise moment did ambition tip into recklessness? Was it the initial burst of debt-fueled expansion, the failure to heed regulatory warnings, or the loss of faith among investors? We invite you to consider where you believe the decisive fracture occurred, and what lessons this dramatic fall holds for the future of global business.